Welcome to the Property Nomads Podcast, and a welcome back to Marc Champ of Wharf Financial. Marc, it's been a little while since we've spoken, and we've got a deluge of news to go through today.
We have. There's been a lot going on, and it's going to make for an interesting conversation, I think.
Yeah, definitely. Although we don't like to date stamp podcasts, I appreciate this is out at the start of October. We're recording this on the Monday, the 26th of September. So there's been a lot of stuff going on with recent budgets and whatnot. We'll try and give a generic sort of overview. As you say, Marc, it's by the time of recording this and by the time this episode's out, it's probably all changed anyway, because it's a lot going on. I don't really know where to start. I mean, we could start literally anywhere today. Stamp duty cuts, our new Chancellor of the Exchequer, tax cuts. We could start absolutely anywhere. Let's do start at the top. Rate increases probably not been increased enough. To be fair, depends on what side of the fence you're falling on. But yeah, the new Chancellor seems to have started off with aplomb and massive tax cuts for everyone, biggest in 40, 50 years. How have you seen the reaction?
There has been a reaction, definitely a reaction on the ground. But what I'm concerned about is the fact that there are two different strategies in play by the people who make the rules. So I said this on an Instagram post about, when was it? Over a week ago, I think. And it was clear that interest rates were coming up. And one of the things Liz Truss wanted to do was to make some cuts. So it made it easier for everybody. But what I said on that Instagram post was the Bank of England's job is to make it more expensive. So it's more expensive to borrow, and that will bring down inflation. That's how the economics works. And that's the plan that the Bank of England have had since, for a long, long time now. They were going to gradually increase the rates, and it was going to go up incrementally, in stages like it has done. And it's been hard for some people to swallow. And that would have reduced the amount of money households can spend. And inflation would have been affected accordingly to brought the inflation back down in time. That was the theory anyway. But with tax cuts, it gives the average household more money. So you've got the Bank of England trying to restrict the amount of money people have in their back pocket, and you've got the government trying to increase it. So with the energy cap that's come in, you've got that. You've got stamp duty holidays. It's counterintuitive. It contradicts. The two sides are contradicting each other. I can imagine the Bank of England's governor, when the budget was announced to them, being like, "Oh my God, what are you doing?" And you can see how the markets have reacted today. They've reacted in such a way that they'd have no confidence. And in times of no confidence, that's when the real problems occur. We saw in 2008, there was no confidence, and people started taking their money out of banks and all things like that. And we're in a slightly different position because we have a lot stronger liquidity position. The risk-weighted assets that banks have, i.e. the amount of capital they have to lend out, is a lot stronger than it was back then. But the fundamentals are still if you've got a negative feeling in the market, that's going to cause a bigger impact than anything else. And I think we've got a bigger negative impact or feeling in the market that we have since 2008, right at this moment. And I know over our conversations over the last year and a bit, whatever it's been, we've been saying, just round the corner, there's going to be dark clouds and everything. This is it. The dollar, as you know, is $1. What was it? 0.3 this morning, something like that, against the pound, and that's not good. I remember going on holiday and going to Disney World when I was younger, and it being like $2 to the pound. Not that I was following the economy, but £2. It was. But I can remember it being a lot more advantageous, and you go over there and you spend your money in America, and you get things a lot cheaper. But We're going to see the electronics prices increase. We're going to see everything. And then I've been thinking about this. I'm sorry just to ramble, but I've been thinking about this, and there are problems. But on the other hand, there's always problems. If I just did a quick timeline from 2008, we've had Brexit, COVID, and the Russia-Ukraine conflict. They're three big things that have happened. And if you look at the interest rate, it is stable still. It is still pretty stable, and it's very low in comparison to what it has been throughout history. And the Keynes theory always says you've got to have peaks and troughs. Things got to go up, things got to go down. And if you look at the interest rate graph from 1950, you see it slowly go up to 1980. It peaks at around 16%, I think. Then it slows off till 1992, where you see another spike. Then it slows down and starts gradually increasing to 2008. We see the crash. Then since 2008, we have almost a flat line, and it's gone up to, where are we? 2.25%. That's not a lot. The rates are still low. Even if they go up to 5%, they're still relatively low. The problem we have, though, is people aren't used to it. And a lot of people, and there's a lot of training courses out there that say, borrow as much as you can, borrow investor finance, borrow from lenders, and then buy a property, do it up, then hold it for rental. That's the model that a lot of people suggest. But that's a lot of borrowing. And when rates go up and jump up, and you're used to a 2% rate, but it shoots up to 5%, whatever it may be, that's a big thing to swallow when you've borrowed so much. That's where the problem is. And I see there's going to be a lot of people who have borrowed too much and are going to be penalised by the increase in rate. Not actually being a high rate, but the increase in the rate is where the problem lies. Because if they borrowed a lower amount, and I always tell my customers, don't over leverage yourself, be sensible, be realistic, rates will go up. That is the problem when you've borrowed too much and the interest rates have increased. And I think that's what's going to hit people. You're going to see a lot of repossessions. I think there's going to be opportunity for people who have not take too much gearing on their debt. And I think there's opportunities out there, but it is going to hit the people who have borrowed too much hard. That's my overview. Sorry.
No, that's okay. That's what you get when we haven't spoke for a couple of months. It all comes out into the open.
All comes out.
But, yeah, I agree. I don't have any issues with that. I think the key things that I would have noticed, my side from recent weeks and whatnot, is that with the pound going, obviously, as you say, going down to $1.03 at the minimum, lowest rate in a very, very long time. I was looking at the physical metal markets on the same day and noticed that for UK people that, and again, six of one, half a dozen the other, it's okay saying that, the gold price increased. Well, it did in terms of pound sterling, but then again, actually, it hasn't increased. It's more that the pound is devalued.
Yeah,
exactly. So two sides to the fence, but in dollar terms, exactly the same. No change in dollar terms. So looking at personal balance sheets, looking at basically beneficial for me, happy days, and also for dollar denominated assets that we have good times. Point being on that it makes things expensive for everyone else. You're quite right. Electronics. A lot of things we're going to see where the price, it's one of those things, is the price going up or is it the fact that the pound is going down? The market will work itself out at the end. I don't think what helps predominantly around the world is that the US dollar remains strong for a multitude of geopolitical reasons. The US dollar remains strong. I guess the only benefit we have, well, there's many benefits, but the biggest benefits I could think that we may or may not have here in the UK is that for some reason, Europe seems to like shooting itself in the foot repeatedly and will continue to do so moving forwards. And, the dollar at some point will more than likely pop down. But yeah, I say it's all a bit of a, part of my French, all a bit of a shit show at the moment, and it will continue to be moving forward. So I don't think the tone of our conversations, I don't think are going to change too much in the next few months. I'd like them to, but I'm not sure that they will.
Well, I looked at a graph with increase versus decrease of GDP in the UK since 1955, and you see it go along, and it goes like this. It's just like a normal up and down. There's not much fluctuation. And then it gets to, say, I think it's 2018. I presume it's sort of Brexit time. And it goes like this. And it's unbelievable, the change in volatility over the last 3 or 4 years in comparison to the rest of the recent UK economic history. It's phenomenal, the difference. And I hope it doesn't continue like that, because that, again, causes problems. There needs to be stability, and there needs to be everybody singing off the same hymn sheet. And the Bank of England and the government need to get together. And I think there's going to be a few people, dare I say, looking at what Labour are doing and looking for maybe a different option.
Well, we have a general election in 18 months, so I guess we'll find out. We'll find out then. Thinking just in my head there a second, and something that we've touched upon before with all these different policies and whatnot that are coming out, that, yeah, okay, fine, on paper you could argue 2 and 4, we can argue till the cows come home. But the fundamental thing that we have both said on this podcast before is you need to address the supply challenges. So it's okay if you're having your tax cuts, for example, but then you still end up with the same scenario of you're going to have more currency, more pound coins or notes chasing, similar or fewer amounts of goods. And of course, that will still increase the price. So I do think that, with the things like tracking and stuff like that, I'm for that, because it's helping to increase the supply, and that's important in the long run. I appreciate that's not a short-term fix, but the positives I take from the weekend would be, fast tracking. I use that term very loosely. Fast tracking various oil projects, gas projects, fracking, et cetera, because at some point, that will benefit us in the long run. But that's a long run thing, not a short run thing. All of that being said, though, Mark, there were a couple of let's move more on to sort of property related things. There were changes to stamp duty thresholds as well. I believe the levy, if I got my numbers correct, first time buyers won't pay stamp duty on purchases for the first £425,000, I think it is. Yeah. And a couple of others as well. What's been the reaction your side with potential house buyers?
Well, we don't do regulated mortgages, so owner-occupied mortgages. So I couldn't tell you exactly what the owner-occupiers are going to be doing or not going to be doing. But what I can tell you is I think there's going to be a lot more foreign investment. With the pound being weak and there being no stamp duty for smaller properties, it's a no-brainer, isn't it? It's you can get Chinese Americans, whatever nationality, coming in and buying up UK property. You get decent yield, so you don't pay stamp duty, and you can get, say, if you buy something up north, you buy an HMO or something, get a 6, 7, 8, 9, 10% yield, whatever it may be. That's not a bad investment on your money. So I think that it's going to actually benefit foreign investors quite a lot. So if I was pivoting my business, that's where I would be going. I'd be looking at them as a broker and saying, which lender can we find to do that type of deal? Because I think there will be quite a few coming over. I don't think it will benefit the average first-time buyer too much, because money's going to be short still. You've still got higher interest rates. You've still got high energy prices. Student loans are issue. There's loads of things that prevent people, and there's still a limited amount of housing. I think you've just brought in another player to the market a bit more in the foreign investors. So in essence, they could actually bring in more competition than previously. So let's see what happens. But I think the big issue, well, there's a lot of big issues, but one issue to consider is also the lenders. Mm-hmm. So if you remember back in 2008, pre-2008, we had RBS, Lloyds, Barclays, HSBC, and a few others that lent money to the property investors. Then from 2011, shall we say, the challenger banks said, right, we're going to do things different. We're going to lend people money, and it's going to be done on an automated system. It's going to be quick. It's going to be not this archaic way of going into your bank manager and having to give your inside leg measurement to get any type of loan. What we see today is the challenger banks struggling to handle demand. And we have seen SLAs that are way and above anything that I would have ever expected. To get a loan through with a challenger bank from initial application to getting an IMO, so an indicative mortgage offer, then instructing the valuation, then the legals, will take you a long time. It will take you longer than it's ever taken. You look at people like Interbay, they've increased their minimum loan size to $1 million. You look at other lenders who have increased their rates dramatically, and I think some of them have done it to slow down the amount of customers coming in because they can't handle them. The actual applications that the challenger banks are getting in is massive in comparison, and it's generally because people want to secure their interest rate now as opposed to a year down the line when we'll probably see interest rates higher. So they can't cope with it, and the actual lead times for a challenger bank are the same as the high street now. There's no real difference. They do other things like their automated valuation methods and things like that, which tend to speed things up, but then all the rest of the process slows everything down. So we've had this new way of banking come in with the challenger banks, but I think they were underprepared for these problems we've had, and it's causing massive problems to lenders getting deals over the line. And customers are having to do things they don't want to do. So we've had to, one of our customers, we've had to bridge the lending process for them. So they want to buy something and they've got to take a bridge out whilst the lending process goes on with a long-term lender.
Wow, that's bad.
Yeah. So it's not something we want to do, but they've got to complete on a property and they've got to bridge it. Another one of my customers, we've got it's a semi-commercial property, and we've got, I think it's about 70% of it's commercial, 30% is residential. So we've gone to the market to find a lender, and as I've spoken to a lot of lenders about it, I found one lender who can do it, and it's an experienced investor. It's a decent location. It's predominantly commercial, but there's a little quirk in that there's a trust behind it. Mm-hmm. But anything that's got a little quirk in it knocks it out from a lot of the lenders. So we're left with one lender who can lend on that. And that can't be right. I just don't see that as the right way it should be, especially with this increase in lenders over the last 7, 8, 9, 10 years. They've all jumped on the buy-to-let and the bridging bandwagon, even though some have now jumped off the buy-to-let bandwagon because the pricing's too high. But even that, we've got another customer who we were doing a deal for, and their rate was something like 3% on a 5-year fix. In the time it's taken to get a bit of documentation, which has taken a long time for one reason or another, nobody's fault, but and definitely not the lender's fault, the rate has jumped up to 5%. So there's a 2% increase. And that you can't predict that at the start of a deal. So it's a refurbished deal, bought a house, converting it into whatever, started the project, say, 18 months ago, done all the numbers. You've got a stress test that lenders will put on it, but that is a big jump even within the process. And lenders give warning. They say, our rates are going to be going up at this point unless it's at this particular stage of the process. But a lot of the time, customers won't be able to get it to that stage of the process to prevent rates going up. So the actual packaging of a case and doing it properly is probably more important than ever now. And sorry, again, I'm going on. We've helped another one of our customers because we had them come to us with a property because the lender who they were using had used a valuer who had given their property a nil value, and that was given a nil value because they thought that there was no rental demand in the area, which is a crazy thing to say because half the properties on that particular street are owner occupied, half are rental. But they gave a nil value, and 99 times out of 100, you will not change a valuer's mind. It's not worth their PI cover. So they came to us and said, what can you do? I said, well, let's have a look at automated valuations, because with an automated valuation, you don't have a valuer going out. It's a computer-generated system that creates the value. And it actually came in higher than what the customer was expecting the value to be. So he's then transferred another 6, I think, properties over to us to do using the AVM. So having a good broker, I'm not saying that just because we did it, but having a good broker who knows the not the tricks, but the ways of being able to get things through and packaging it correctly so there's nothing missing in the pack. Because if there is something missing in the pack, a lender will come to you and say, we're missing this. Then the SLA starts again, and the SLA being the time period. So it's going to cause massive delays. So I think it's more than ever, people should be looking to the professionals to help them get these deals through, because the environment that we're working in at the moment will trip people up very easily.
Just a note on AVMs, actually reminds me of a recent experience. There's a podcast that I'll do set in a few weeks. Because we had that situation recently where basically it turned out wonderfully, because it turned out it's true money in money. We got paid to buy property, which it's one of those things that you hear people talk about until it actually happened. You think but it actually happened. We got paid. We got paid to buy a house. Wonderful. That's what I like. And that was down to the AVM. Exact same thing. And it's everything you've just said. A lot of issues with, and I won't name the bank, but a lot of issues with said challenger bank to start off with. Very slow, service level agreements, SLAs for people that are wondering what they were. Very slow with that. Querying, well, how have you bought it in the first place? When did you buy it? How have you got it for so low? For the original purchase price, why do you think it's worth this now? What works have you done? What's your inside leg measurement? Mother's maiden name? Do you have a cat? Anything you could think of. That was it. So again, working along that process, and you get the usual, what do you think this property is worth? I put down an amount that I thought it was worth. And they came out of an AVM that was substantially higher, over 10 to 15% higher than I put down on the paperwork. And I was, quite decent with my old knowledge of the area, comparables and whatnot. And they've come in with a much higher valuation. Okay, great. I'm not going to complain if you're going to do that. And then from that point, actually, the process was quite speedy, no issues at all. But you're right, getting to that process, getting to that stage in the first place it can be an absolute nightmare. Even if you are really well prepared, to me, there always still seems to feel, I feel like there always still seems to be, just that extra question. A couple of extra questions here. I was like, oh, now the SLA's reset itself again. It's like, oh, now interesting. And going back to what we were saying, with everything that you've said, that this is going to continue. Interest rates for the time being are only going to go one way, in my opinion. So everything we spoke about today, it's going to be an ongoing, certainly for the next 12 months, in my opinion, it's going to be an ongoing thing. Is that a sentiment that you would agree with?
Yeah, analysts are saying base rate will be up at 5%. In not too distant future. I can't. The lenders are factoring it in anyway, and they have been because of where the swap rates have been. But it's only going to go up because if you're looking at a 5-year fix for a property investment property, a specialist property investment, you won't get anything cheaper than 5%. That's where it's about. And if you think this time last year, there were probably about 3, were they? Something like that, just under 3 we were doing. You look at the likes of Landbay and LendInvest, for instance. LendInvest, their SLAs are really good at the moment, but I'm not surprised because their rates have gone up so much. And it's not their fault their rates have gone up. The rates have gone up because the actual money that they buy in has gone up. So they can't do anything about it, but their USP was cheaper rates. You've seen the bridging lenders who have, a lot of them lost their funding. Some of the American funds have pulled out. And I did a YouTube video with the co-founder of Avamore Capital, who I know very well, really nice guy. And we had a good discussion about, it started about how to set up a bridging lender. Mm-hmm. And then we went on to funding and all things like that. And then we started talking about the market. And it was really interesting, and hearing the mechanics of buying in money when you're a bridging lender and the different funding streams, because there's a lot of bridges out there, but Shawbrooks fund a hell of a lot of those bridging lenders. So people probably don't realise that there is, I think some is around 30 that they fund. There could be more, could be less, but that's quite a big proportion of the market. You have to also think, with the problems we've got in the UK, people are going to be worried about it. We've seen the dollar weaken, so probably see people who are funded in the UK more nervous about what's going on in the UK. So these bridging lenders will probably have increased finance costs. So it's really important that you back the right horse, because I think it's going to be a bit wobbly for some of them. And I've said that for a long time. And I remember us two having a conversation about making sure you pick the right bridging lender, not just on rate, but on how stable they are and how many funding lines they have, who their funding lines are. They're the questions that people should be asking, not how cheap can you get my rate, in my opinion, anyway.
Again, I have no qualms with that. What is it they say? Never question the cost of a shovel when you're digging for gold. Yeah,
exactly. So exactly that. It's bridging funding can go quickly because it's the most expensive and therefore the most risky part of the process, because people price risk, and it's going to be interesting. We've seen some lenders already pull out. I think we're going to see more, and I think some customers are going to fall foul of the way the market's going at the moment. So make sure you don't over leverage. That's my thing. Don't over leverage.
We can roll with that for an episode title, actually. So don't be surprised if that's the episode title. Oh, what I would say, Marc, is if we can just do a sort of very quick summary of that. So apologies. It might all sound doom and gloom, but we're being realistic here. It's, talking from our experiences, trying to help, those listening to the show, how to, help themselves move forward. But just in summary, pound effectively falling off a cliff, might recover slightly by the time this episode comes out. But in effect, what that is going to do is it's going to make FDI, foreign direct investment, cheaper. So people coming in, looking at UK housing from abroad, our market is now incredibly more attractive than it was, say, 12 months ago. Regardless of what goes on, we're politically stable as a country. When you look at history. So that's always advantageous as well. Yes, the Chancellor and so forth, new government have made a set of tax cuts. On paper, well, hey, but in effect, that's going to stimulate demand without looking really at the supply side. So, as vote winning as these things may or may not be, price is still going to go up anyway. So that's going to happen. What else? I think that's probably about it for this episode. Any final words of wisdom for this month at all?
I think I could keep going. There's a lot more to say. And when we first started this episode, I said throughout history, there's always been ups and downs. Since 2008, we've seen a lot going on still. And like I said, Brexit, COVID, everything like that. And everybody was, oh my God, this is the worst thing ever. We will ride any storm because that's the way economics works. It goes up, it goes down. Some people lose out, some people don't. We live in a capitalist society. We're not a communist utopian world. It doesn't happen like that. There will be opportunities for people. And these are the times, in the hard times, when people make money. It's easy to make money when it's good, but it's easier to make a lot of money when times are hard. So for me, invest wisely, don't over leverage, be sensible. Remember, property is a long-term game. You can make a quick, easy bit of money every now and again in property, but over the long term, if you invest sensibly, invariably you'll do pretty well. So think about it. Talk to wealth managers. I always say talk to wealth managers because I think getting set up with the correct structure in the background is important, because at the end of the day, people don't do property because it's a hobby and they like bricks. They do it to make money. So make sure you speak to a wealth manager to get everything set up properly. It's really important.
Amen to that. Great place to finish the episode. Marc, thank you very much. For people that want to find out more about Marc and Wharf Financial, links are in the show notes. Sign up for the newsletter. Highly recommend it. Loads of great content in there as well. And I'll catch up with you, Marc, in a few weeks' time.
Yeah, thank you very much, Rob.